All right, a quick disclaimer. We do not know everything. We know something and we like to share and we keep learning. So if you see any errors in data, we appreciate you give us an alert. Or if you want to discuss any certain topic further, please feel free to reach out to us after the event also. All right, so let's take a quick glance at what have happened in Q1 2026. Our team here has selected some news headlines that highlight what the key pattern in Q1 2026 and have grouped them into key theme. Energy, of course, energy price and energy security must be the two keywords that you have heard most in the last month. It has dominated the headlines, and obviously the ongoing tension in Middle East have sent a shockwave across the globe. And we are seeing that government are taking different approach in adjusting or coping with this crisis. We're seeing countries, going through their security by finding alternative source of supply, working on incentive and taxes relief to cope with the hike in price. We have seen countries revisiting partnership and strategic supplies strategy over the last month or so. And for Cambodia specifically, we have seen drastic change in terms of price. However, the supply is still somehow maintained for the overall operation in Cambodia. We'll touch a little bit more on the energy topic in the coming slide. In the financial market, predictability, of course, remain the what investor value the most. And apparently, there is a short supply of that right now. Volatility has picked up across the globe, especially due to the geopolitical risk. And in Cambodia, the challenge has also been more structural, such as the risings of NPL is still remain a concern. We're also starting to see stringent enforcement on illegal financial activities, which also again are sending a lot of concern into investor. But also we're also seeing some softness in consumer confidence. Now, outside of the NPL issue, the broader system remained relatively contained and resilient. In the next theme that we noticed also in industrial market, Cambodia, despite all ongoing uncertainty, we are seeing industrial sector continue to be resilient and growing, as well as just looking through the FDI and QIP data, we already see that there's an upward trend across 2025. A little bit more on the macroeconomic, we like to look at the key indicators. Overall, the GDP growth and inflation is still relatively maintained. We are seeing that the latest forecast by World Bank still forecasting Cambodia growth in 2026 to be around 4.3%. And FDI and QIP, as I mentioned earlier, throughout the last year has been on the upward trend. However, it was noting that this report and this trend that we witnessed happened before the crisis or disruption around the geopolitical changes. So it's probably too early to say how this crisis will play out into Cambodia macroeconomic landscape. On the liquidity and rate, we are seeing that interest rate remain elevated, reflecting the tighter liquidity condition and in the banking sector. Although you also probably can notice that since the beginning of 2025, interest rate in Cambodia, both term deposit and loan rate, are adjusting gradually downward. This may be reflecting of commercial banks in Cambodia trying to gradually recover investor and loan performance. In the investment and asset aspects, when we look at the residential price index or PPI issued by the National Bank and the gold price, we can see that residential has contracted a little bit and gold price remain largely volatile, especially in the last month and or 6 weeks. That we're seeing a gold price been dropping down and rising up and then dropping down again. And as a we see in our poll today, a lot of people are still interested in investing in gold as it pursued as a long-term preserve of value. Onto the key real estate indicators. Here's a quick snapshot of where the prices and rental and occupancy are across the key real estate subsector. Overall, we are seeing a mixed picture. Office and retail rent showing some stability, while residential segment, including condominium and landed property, especially twin villa price, has contracted slightly. I'll keep this slide or number at the high level for now, as we will dive deeper into each segment in a later section. Now, I want to introduce this slide in the beginning of our presentation today, because building on what we've just seen earlier in the key indicators, it's important to understand what brought us here. So let's take a quick walk down the memory lane for the in the last 15 months of in Cambodia economic aspect. Cambodia has faced a number of shocks, both internally and domestically, from credit slowdown to trade disruption, tariff turbulence, and then now most recently to geopolitical tension and financial system stress. Of course, we couldn't know what comes next, but I think the key takeaway here is clear. The resilience and preparedness are the absolute key for business in 2026. So in short, plan for rainy day while stay ready to capture opportunity when the sun returns. Although you can say the sunny day may still some distance away, because it's important also to recognize what continue to shape the environment in the coming days of 2026. In this slide, we recap the last 443 days of Mr. Trump administration, which is, you can recall, less than 1/4 of his whole administration. And we already seeing a lot of, President Trump, love him or hate him, you can see he already have a global impact and hitting almost everyone life in the planet Earth through a series of usually described as aggressive and often unpredictable measures or policy move. We can see that geopolitical landscape and economic landscape worldwide is being continue to be volatile. And in this is key point, while shock can happen very quickly, as we can see in the last, several policy turn, recovery and policy reverse or normalization may take much longer. And that's have a very direct implication for investment decision and especially for real estate decision, which is usually need long-term planning. In the immediate term, the most intensified crisis and challenge that everyone is facing right now is the energy price. Energy price is one of the most disruptive force of all, because it related in so many sectors and almost everything around our daily life. Particularly in our part of the world, Asia and Asia Pacific, we are heavily relying on the energy that come out of the Strait of Hormuz, as you have heard many times already through the news. We see roughly 30% year-on-year increase in price in term due to the disruption in this small choke point. For Cambodia specifically, as a non-oil producer ourselves, the rise of oil price locally are now approaching the previous high during the COVID crisis, as you can see as a result of comparison here. And the impact of this energy price hike is unavoidable, and it will actually impact a lot of sector, and the next slide will tell us why it matters. What matters is the ripple effect of this rising oil. So in Cambodia economy, as you can see here, what is being hit firstly is rising of inflation, trade disruption, and a squeeze in consumer, especially household consumption. At the same time, government has stepped in to elevate the situation and relief. Hence, we're also seeing a tax relief incentive being introduced, and in turn, that would also result in fiscal pressure over tax revenue also. And this will continue to lead into other sector, especially for our sector, construction and real estate. We can expect that there will be a softer demand. There will be a delay in decision making because everyone is, couldn't predict what's going to be the next pattern. And then the impact will continue to flow into the manufacturing, industrial and logistic, rising of production costs and operation costs. And of course, one of our main economic pillar, which is tourism, with higher travel costs and a number of visitor fall, or in other words, their budget being cut down. And then again, we'll loop into the demand for hospitality and commercial property. In the financial market again, so far we have looked at a lot of pressure driven by the cost of production. But when we look into financial market, the M2, broad money M2 represent the total market being circulating in the Cambodia economy, including cash, saving, and deposit. After a period of expansion, we've seen that M2 has peaked and started to decline slightly in recent months. That's a sign suggesting that there's a more cautious environment around investing in Cambodia. There's a slower credit growth, tighter liquidity, and more selective lending across all commercial banks. In practical terms, this means that there's a less capital flowing into economy and especially into real estate market. Despite tighter liquidity and rising uncertainty locally within the locally used fund, we're seeing that influx of FDI remains strong, with last year number value hit 5 billion, representing a 16% increase on year. However, it's also important to note that this very much happened before the current crisis being hitting. On the QIP, in addition to investment, we're also seeing that QIP follow a similar trend, with last year new investment being approved hit up to $900 million USD, with over 100 projects being approved. This trend is also mainly driven by industrial and infrastructure. Again, these are very crucial aspects of long-term growth sector. However, we should note that the immediate translation into economic benefit and activity may have a lag. And finally, in macroeconomic sector, we'll be looking at the tourism, one of Cambodia's key economic pillar. We're seeing a decline of up to 15% of international tourist arrival in the last year, with only 5.6 million international arrival throughout the 12 months of 2025. This suggests that while the movement is still there, spending power and travel confidence are being impacted by the series of global shocks across the globe. For real estate, particularly hospitality and retail demand, it really reinforced the demand for hospitality and commercial real estate property. So we'll see how this play out into the following segment. So to close off this section across the macro, financial, investment and tourism indicator, the message is quite consistent. The market is adjusting under pressure. So with that context in mind, let's now turn into each real estate subsector and see how these trends are being playing out. So let's move on to office market pulse. In the last 3 months, the first 3 months of 2026, we have seen a number of new completion, but also more interestingly, the new launches of new commercial projects, namely GIA, which is located in Gonorrhea, the new satellite city being actively developed. FTB Tower coming up to completion very soon in this year. Norodom Business Center, Both are locating in a quite a center of the city, and Royal Group Central also and GDT Tower are recently completed. In the overall Phnom Penh office supply, we are seeing that supply continue to reach new highs every quarter. And specifically for 2026, we're expecting grade A supply to expand quite substantially. Actually, we already see that 55% of the expected supply in 2026, which is around 144,000 square meter, already been completed, more than half of it. So, and grade A is clearly taking a dominant in the new supply completion right now. And if this trend persists, by the end of 2026, we'll see the total market supply for office in Phnom Penh, including strata title and stratally owned office, will hit 1.3 million square meter. Of course, the market supply will reflect in occupancy. And as you can see here, occupancy rate has been quite resilient. As we can say, the market is not collapsing, but it's clearly separating winner and loser very quickly. With the new supply being introduced, quality and service are being improved, especially across the newer grade A completion. We are seeing that occupancy in grade B and some older grade A is being impacted, and Prince Group being under a clearing process by the government has also sending out a number of tenants in their premise into capturing some of the better quality, better due diligence, or better background of developer as well. So reputation is also coming as a very crucial due diligence process of tenant also. Similar to occupancy, rental rate is reflecting the introduction of new office supply currently coming into the market. Very consistently, we are seeing that there's a continuous flight to quality across the board. Business are moving from older grade B and then moving into the newer grade A, especially within the city center area like Dong Peng, Diamond Island, and upcoming location like Gonorrhea are being under a close look right now by tenants that having planned to move within 2026 and 2027. So it's clear that we can see across the board here, grade B and especially grade B and CBD and non-CBD are seeing the largest hit in terms of rent reduction, up to 5% and 7% respectively. To close off the office section, there are 4 key shifts that we would like to highlight during this quarter. Number 1, grade A office supply is reshaping the market. That's a trend that we believe in very strongly, because the continue of rising of grade A new supply is intensifying the competition. The quality expectation, service expectation are all rising across the board. So it's require existing building to upgrade and update their service gradually. Number 2, the demand is becoming even more intentional right now across the tenant. Tenants are no longer just looking at the space and price, but they are also looking at amenity being offered in the building that they're coming into also. Number 3, tenants are now choosing landlord not only because of their building, their service, but also the reputation, the background of the landlord, and their other or relevant business. And lastly, trends number 4, the cost sensitive continue to drive the negotiating power between landlords and tenants. With tighter budget, tenants are more price sensitive than ever right now, and shifting leverage toward occupier and putting more downward pressure on the rental rate. That's what we can expect in the coming quarter for office market. Moving on to check retail market pulse, very similar to commercial market, office market earlier. We are seeing new phases of a new project being announced. Chipmunk Group is announcing their new upcoming 6A, National Road 6A mall. GIA Noria, which we mentioned earlier, also have a retail component in it, and GDT and K Mall Breakdown. These are two newest retail project completion in the last quarter. In terms of retail supply, we still continue to see a gradual return and gradual completion, although the rate of completion is not as sharp as what we saw in office market. And in the coming, for the whole 2026, we're only expecting up to 36,000 of new supply being completed only. And up to 45% of those already completed across due to the completion of GDT Tower and K Mall Breakdown. And we can expect that the supply continue to grow in a modest and slowest way, as we can see that landlords are now being more cautious in introducing a new supply. I think that this is could be my most favorite slide ever for retail market for every presentation, because in terms of when we look at the retail expansion and movement, we continue to see brand expansion continue to be very active, actually up to 43% new branch expansion just in the first 3 months of 2026. We also continue to see new brand entry, and noticeably a lot of new Cambodian introduced brands from local conglomerates and younger entrepreneurs, especially in the realm of convenience store and supermarket chain. And we expect that probably not all of these brands will do well or equally well in the next 2 to 3 years. We may see some winner, loser, changing face still, but I think for the consumer, they are the winner here. So in terms of choice and in terms of of pricing and affordability option is very vast across the board. Occupancy, although we're seeing a new expansion and new brand entry, we still see that occupancy continue to soften, especially now with a new supply that coming in Q1 2026 and continue to see across the 2026. New supply continue to add vacant space into the market, and we can still see strong interest and preference towards standalone and or like mall front location. Some larger retail centers or retail podium may continue to suffer in the coming quarter. Rental rate trend is also taking moderate stand, suggesting reflecting the overall occupancy pressure. As you can see here, as we mentioned earlier, prime high street or standalone store remain the most, hence their rent only up to 6%, but across the board, the type of retail continue to moderately adjust. To close off the retail market, we like to introduce a 4 trend also. First of all, we're seeing local F&B operator continue to develop their own brand identity and introducing or incorporating the cultural aspect into more and more into their business and marketing activity. Number 2, we're seeing a number of local convenience store and international convenience store as well actually continue to grow. Number 3, trends, we are seeing high traffic, especially among tourists in certain location, especially retail high streets such as BKK1 along the riverside and surrounding the walking street across the tourist area along the riverside and around the Royal Palace. And the last trend that we are seeing is that very interestingly, education, whether it's a full-time school or extracurricular activity, starting to become one of the key anchor tenant in retail centers, taking quite a significant space and filling in retail center, but also acting as a magnet to attract new footfall into retail center as well. So with that, I would like to conclude my presentation for this morning and like to hand over the floor to my colleague, Kim Sie Chia. Over to you, Kim Sie.
Thank you. Thank you, Mokasa, for a very detailed presentation and touched on the economic side and also the commercial side. So before I start, I would like to properly introduce myself again. My name is Kim Si Chia, and I am the manager of research and consulting department at APS Cambodia. So the first part and the first section that I will be covering is the residential market pulse. While residential is such a wide word, within this sector, we will be covering three main sectors. First is the condominium sector, second is the landed property sector, and the last such sector is the service department sector. So let's move on to the condominium sector. This slide is showing the completions that is currently pushed out into the vertical living market. Now, Bipoptumay Condo Sansok is the first project that is launched, and also the milestone for Bipoptumay to enter the vertical living market. This product has been launched in less than a year and is now currently completed and have already handed over to some of the buyers in the market. The ramp up is also something that I would like to point out as well, where such a vertical living market is a market that is very new to this developer. However, the ramp up speed from the first project up to the fifth project, as we heard of, as of Q1 2026 by this developer has been spread out. So what's the question that I would like to answer is, how is this ramp up make sense in this market? Well, this is personally speculative from our side, but we believe that this is the market that show the strongest demand, where the absorption rate is very healthy across the market. In the following slide, you will see a clear picture of why this market is very healthy. Well, on the right side is Diamond Bay Garden. This property is a really good property located on the riverfront. I'm pretty sure everyone has already drove past the Noria new bridge, where this project is positioned on the left side. This building is expected to complete within 2026 as well. So in terms of completion, we only see one project as of Q1 2026. This is an additional 1,800 unit plus into the market. This is a 26% quarter-over-quarter growth rate. Move on to the next slide. So on this slide, we are looking into the new launches that is currently launched within the first quarter of 2026. Now, new launches is now concentrated mostly within the affordable and mid-range. However, if you notice in this slide, we are seeing some of the new high-ends that has launched in 2026. This is also signaling the pickup and a slight recovery in terms of demand for the high end. However, you will be hearing me stressing and talking a lot about the affordable and mid-range segment, where the market is the most healthy. Why is it healthy? I believe that the developer is now seeking and more understanding and more well-adjusted to the new demand within the market. The demand landscape, if we compare to the pre-COVID period, is very much different. The concentration of international investor and the investment products in the market is now subsided, and the products that is currently being pushed out or currently being absorbed in the market is more concentrated within the buy to use segment. While buy to invest to get a return is still being spotted in the market, but it is very much more less in terms of popularity. This is also reflecting in terms of the drop of the investment yield, where in pre-COVID period we are seeing the investment yield is very healthy. The minimum is around 8%, and it could go up to 12 to 13 to 15% of the investment yield. But however, in 2026, the investment yield is now dropped to approximately 6 to 8% max, where this percentage is very much unjustifiable and is not deemed as attractive as before. So the products that we are seeing is more reflecting and representing the current market, where we also seeing a growth in local openness in exploring the vertical living market. Now we are seeing the population is now pushing older generation forward, where 50% of our population right now is dominated by Generation Y and Generation Z. We are the new demand driver in the market, and we are more open, we are more explorative, where vertical living is deemed to be more acceptable for us. So now the products from the developer point of view, the developer has to understand who are they selling to. The market is not the same, where these new launches is reflecting that understanding from the developer side as well. This is also what I already touched on. This graph is very fun to look at. While from Q1 2022 up until Q3 2024, the market is very much at a stage of wait and see from both sides of the market, from the developer side and also from the buyer and investor side. However, in Q1 2025, we have seen that from the developer side, this is a stage of realization where there are actually demand in the market. And in order to be successful in this market, you will have to understand the demand and push out the products that is currently can absorb in the market. Now, Q1 2025, we have seen a dominant of affordable with a mixture of mid-range, where in Q1 2026, we are starting to see the comeback and the return of high-end market. On the supply side, this is a general overview of how the growth of the supply is currently doing. In terms of completion, it's also very much reflect the absorption in the market. Now, I would like to stress that this product is a upland sales product, which means that the completion is reflecting the absorption and the health of the absorption rate. Now, the product will be able to complete into the market if the sales rate is achieving a point where the construction cost can be justified with the return of the investment. We will keep seeing this trend moving forward. However, from our point of view, we will be expecting the completion to be more concentrated across the affordable and mid-range. I also want to point out the mass market, the market driver here, is still dominated by mid-range. Now, mid-range, since pre-COVID, mid-range and high-end is the most attractive products that has been introduced to the market. However, the pickup of the affordable is expecting to ramp up, and the percentage share of affordable is expecting in the near future, in the next 3 to 5 years, will be keeping increasing, and the share will be justified to the current mass market of mid-range. However, as of Q1 2026, mid-range is still the dominant in terms of completion in the market. Let's move on to landed properties. I believe that 80%, maybe 90% of the attendees in our event is Cambodian. And I believe that you agree that landed property is still the #1 go-to when you first think of buying a first property. I also want to point out these are the products that's currently being completed into the market. But before I move on, I want to explain what is the word completion here. So previously we wait until the whole development is already completed and handed out to the buyer before we can count them as completion. But in this line, we also counted some of the projects that is already completed a portion or phase that they have been introduced to the market. So we can properly reflect the actual market movement. So for an example, Vung Resident is a project located to the southern area, closer to the new international airport. This project is currently still ongoing, but some of the products such as the commercial building and the shop house area has already been completed. So we should start counting them as a completion into the market. I also want to divert your attention to where these products are concentrated. Now, in Cambodia, it's much more different from other more mature market, where buyer is seeking products that is further away from the airport because of the concern of the noise pollution. However, here in Cambodia, the development is seeking the location closer to the mega infrastructure, not only just counting the new international airport. We have a couple of major infrastructure developments, such as the new access road to the new international airport. But the noise pollution is never been a concern because from my perspective, our market is more focused on the capital appreciation of the product. Now, capital appreciation is reflecting the high traffic flow, more density of residents in the area, more activity, more commercial activity in the area. So this is where the developer is chasing, and also the buyer chasing. Now, in the next slide, you will see a more transparent answer into this, where this is just the completion that's currently pushed out into the market, where all this product has been launched 3 or 4 years prior to the completion. So let's move on to the next slides, where we will look into the new launches of landed property. Now, as you can see, the concentration of new launches of these landed property products are more concentrated in the southern area. From our perspective in this market, we believe that southern area will be continuing seeing new launches, because the land price in the area is still very much minimal for the developer to be feasible in terms of introducing a more affordable and located a bit in the mid-range products within this area. So what's the future outcome of this area? Now, in the trend of the real estate market, we see the same pattern. The residential comes first, and then the commercial will come later. This area will be, I wouldn't say strongly, but it will follow the pattern of the Russian Boulevard that's connected to the old international airport. Now we have started seeing some commercial activities coming into the Hun San Boulevard. As you have seen across the road, we have seen a lot of car showroom has been established there. And there's a lot of commercial activities such as Aeon Mall, and also a couple of community mall along the way, and also some of the high-end residential from key market leaders such as Borai Peng Hood and also Chipmo Group. So commercial will come after this area has been populated, and the demand is currently being supported, and can be supported for those products, commercial product, to come in. So I will not go through much on this slide. It is very much the landed property supply as of each quarter. The completion is very much not as aggressive as before. Because just like I mentioned earlier, this is a upland sale product and the completion will reflect the actual absorption rate in the market. While what interesting is that within the landed property market, it is very much split 50 to 50 between affordable and mid-range, where high-end is still a small and niche market player. I also want to reflect back to what we mentioned earlier before everything has happened, where the market is now more stabilized. We believe that the market is heading toward the beyond the high end, but more going to the luxury market. But now when we reflect back to the current market and also the speed and the ramp up of the market, we believe that this is not going to happen anytime soon. Or if it will happen, we see some of the luxury market entering. However, the performance is still very much very slow. And this market will be coming into the market, but not anytime soon. I believe that my time is reaching the time limit, so I will go through a service apartment market quickly. Now, service apartment market, from my perspective, is the most healthy market in terms of the balance between the demand and the supply. It is not oversaturated on the demands on the supply side, while the ramp up is very consistent across the board from pre-COVID, during COVID, and post-COVID. In Q1 2026, we are seeing a new upcoming product called Champs-Élysées. This project is a Grade B service apartment located in Dong Ping and is expecting to complete within Q2 2026. And the rentals, as we have observed, is very much fitting and also very competitive in this market. We also see some international branded operator from Citadine in Vuastan is planning to start their operation within 2026 as well. So we are keeping our eyes out for this project. UC 88 Windham Garden is also the other branded residence that is also planning to complete and open their operation in Cambodia as well. Now, I also want to touch on some part of this as well. Why is it taking so long for this branded operator to start the operation? Now, the operation setup it takes quite a while because the structure is very much different from branded resident to branded resident. Some branded residents, they will need some time to do their fit out since they have their checklist of criteria that they have to meet before they can start their operation. So please be patient, but of course, they will come into our market. On the rental and property price is very much stabilized. It is not a drastic change of 5 to 10 or 15% as in 2022 and 2023. We believe that the market will be stabilizing in 2026 and hopefully that in 2027, we are starting to see a more consistent upward adjustment quarter over quarter. I also want to divert your attention to the rental market. Now, from our perspective, after we have seen the pickup in terms of inquiry in the rental market, we have seen a pickup in the demand across both condominium for rent and service apartment for rent, where this product is currently the hotspot for our inquiry. So it's also reflect the market quoting rental rate for condominium and also for service apartment, where we see some quite consistent of the upward adjustment for the rental rate as well. So the key takeaway for the residential market is that the reputational developer projects sell performance still improve. Now we have already stressed about this trend a couple of times already, is that in this market, it is not an easy market to enter. Now, in order to be successful in this market, you will have to build your reputation, your trust, especially after what has happened in 2025 on moving on to 2026. Reputation and trust is a key to make sure that your sales performance is ramping up. So we have seen in the market already where the successful is being seen in across local developer where their name is already well established. It is harder for new developer, new names to enter the market, but it is not a no. I mean that if you want to join, if you want to invest in this market, if you want to inject your capital in this market, please maybe talk to us first. Maybe understand the market, understand the consumer, understand the buyer, understand the landscape of this current market and what is to be expected in the future. This is how you will be successful or be competitive in this market. On the second part, buyer has greater trust in local experienced developer. I already touched on this as well. So we will go on to the third part. Developer enter the market will be better market positioning. I believe that I already touched on this trend as well, where developer will have to be critical in terms of understanding the market. It is not an easy market to enter as the pre-COVID, where the products can be introduced and be sold out within 1 year. This need a lot of study. This need a lot of understanding of the market. Now, on the landed property side, developers started to launch a smaller phasing, sometimes 10, sometimes 30 units per phase. This is showing a sign of slowdown in terms of demand for landed property as well. Now, affordable property, I already mentioned that Generation Y and Generation Z is more open to more affordable and mid-range products. This is transparent and high-end product is more focused on the investment and investor side, or those who are prefer to have a better located products and a better fitting out products. We also seen a lot of sport complex facility in the use as an amenity, where this is also a consistent trend across a newer generation, where sport and outdoor activity is very much favorable. I believe I'm running out of time, so let's move on to the last section. Is the industrial market pulse. On the industrial projects launches, we have seen that there's a lot of support from our government. On the Kanaya Special Economic Zone, this is actually not a new launch. This is a repositioned. Now, previously, this is a project that is positioned within the logistic park, but has now transitioned to special economic zone. Speculative from the market, I believe that this is also shows that the demand from the market is more concentrated to the manufacturing side, and also the export oriented side. Moving on to Phnom Penh Logistic Complex, this is a project that is has already been granted and located in Kampong Speu. This project will be mostly focused on the logistic tenants and is aimed to establish a centralized logistic hub in Cambodia. These projects will be a challenge market to enter. However, will be a great addition to our industrial market, where logistic hub in Cambodia is a need, especially for expanding, moving on from just local industrial into warehouse. So this slide, I will move on quickly. We have seen that in 2025 and 2026, the green-lighted special economic zone is still ramping up heavily. So we try to question why is that, since in 2025 to 2026, the market from the macro, from the international situation, the war, these are the matter of why this special economic zone is still being green lighted. Now, from outside, we believe that from the developer side, they believe that this is just a temporary issues and it will be solved. It will not take up to 3 years, while this development is a long-term investment. In special economic zone, this is not a 5-year development. This is a 10 to 15-year development. So this is a future development where currently, if there's an opportunity for them to get the green light for special economic zone, they will. This slide is very much interesting, and I also want to touch on the gap between the cost of setting up here in Cambodia. While in special economic zone, the rental in both sales price, by sales price I mean long-term lease, and on the ready-built factory rental rate is also much lower. The gap between these two products is from 14% to 18%. So now, why is that? Well, in Cambodia, special economic zone is offer more a complete setup. You're looking at more reliable infrastructure that's already established by the developer. It has better power stability, and it has stronger logistic connectivity, better located. And on top of that, the regulatory process is generally smoother with custom support and investment incentives that's being offered. So it's especially attractive for export-oriented and manufacturer. And for ready-built factory, this become more relevant. Being in a special country faster, with less setup risk, everything is already in place. So the setting up process is much smoother and quicker. On the other hand, standalone location is still more cost efficient. While this is very much a preferable depending on the tenant preference. However, if they choose to seek a more cost efficient standalone outside special economic zone is a way to go. Now, I want to touch on this slide very quickly. However, this is a very interesting slide. Why is it interesting? Because this is a interview that we have done across market expert, across logistic, manufacturer, and the government side as well. Now, the higher is the better in this rating. This is the question that we have asked to these experts of what is the areas that they think has already well established and where's the area that needs improvement. For the areas that needs improvement is still infrastructure and logistic. While we have seen a lot of infrastructure development has been introduced by our government, it's still insufficient enough to support and to improve and enable a more efficient logistic side. One other thing is ease of doing business. I have seen that our government has been very actively digitalize our process of setting up businesses in Cambodia. That is a good thing. And I hope that we start to see ease of doing business in Cambodia to get more efficient. And also the rating in the ease of doing business done by World Bank is started to climb, because right now we are placed at 100 and over 100 place. So this is the area that we need to improve as well. Labor force, despite we have quite a lot of labor force, however, the quality labor force is still a concern. Now, in order for the manufacturer to set up here in Cambodia, they will need to on the extent to do and conduct a training to make sure that the establishment of this manufacturing will go smoothly. Now, labor force is in need of improvement as well. Go quickly on the government long-term vision. This slide I had already presented before, but I just want to quickly point out is that the government has the vision to improve our logistics, and this is the plan that the government has been set since 2023 up to 2030. Now, the government has allocated a large portion of the budget for these products, for this infrastructure development. We have seen some of the movement on the expressway. So there's a couple more expressways that's coming up. There's a lot more railways projects that in plan is currently under study as well. So I believe that this is a really good, well-rounded strategy from our government to make sure that the logistic improvement is necessarily see light of day. I want to go quickly on the trend. Recently, we have seen our government started to reduce tax in terms of import tax on the green related products, and especially more concentrated on the electronic product. So why is that? Well, our government is very much focused trying to climb the value chain in the industrial sector. But do you think that our government is trying to compete with Vietnam as a manufacturer hub? No, of course not. Well, our government is trying to be what's so-called Vietnam plus one. Now, Vietnam is very well established in the manufacturer industry. However, we are planning or aiming to be the assembly side of the value chain. Now, this tax cut will make sure that the established of this assembly plan will be more cost efficient and cost competitive in terms of export value. So the products that's currently been reduced in terms of tax are EV car parts has reduced to only 7%. For the EV car has reduced to zero tax import tax. So this is a good news for a new chapter for our assembly market within the industrial market.